Just wanted to ask about the Community Reinvestment Act, since the FDIC and OCC may potentially join together for a proposal without the Fed. Are you concerned that this might cause confusion, and how would the mechanics work if this proposal is finalized without the Fed?
So, we think the CRA, we know the CRA is a very important law, and we're strongly committed to the mission of ensuring that banks provide credit to throughout their communities, particularly addressing the needs of low and moderate income households and neighborhoods. We also think it's time for modernization. We've thought that for some time, and we worked very hard to try to get aligned with the OCC really on a proposal. And my hope is that we can still do that. I don't know whether that'll be possible or not. We'll just have to see. And if we can't, I'm not sure what the path forward would be. We would certainly not want to create confusion or sort of tension between the regimes if they do turn out to be slightly different regimes. So that's something I hope we don't have to face, but we will if we have to.
Hey, Brian, for the last question.
Hi there, Brian Chung with Yahoo Finance. So before the July meeting, you said something kind of colorful. You said to call something hot, you would need to see some heat, referring to the labor market. So to expand a bit, I guess, on Nancy's question, it seems like the wage Phillips curve has been pretty well explored already. But what would you need to see to call the labor market hot in that case? Would it be some sort of change in either the headline number of gains or in the unemployment rate?
Really, wages. I mean, there's so many other measures that suggest that the labor market is, I'd like to say the labor market is strong. I don't really want to say that it's tight. Someone asked me a question about a hot labor market. That was in the Humphrey Hawkins hearings. So I'll say that the labor market is strong. I don't know that it's tight because you're not seeing wage increases. Ultimately, if it's tight, it should be reflected in higher wage increases. So it does come down to that. We look at countless measures of labor market, labor utilization, and there's so many, it's too many to count. But the one that is kind of suggesting that it's a healthy number, that the sort of 3.1% average hourly earnings number is a decent number. 3.7% for production non-supervisory workers is more healthy. Ultimately, though, we'd like to see, to call it hot, you'd want to see heat. You'd want to see higher wages.
Thank you.
Thanks.